I was trying to summarize, hit the sort of the high points of a very big story you could tell today when you look at the U.S. economy and where we are in terms of recovery. So I picked a title, The Tailwinds and Headwinds to Near-Term Recovery. So I'm trying to be very specific here. And this is sort of my opening joke. I mean, we clearly know that we followed our grocery baskets and our shopping carts into a fairly deep downturn here, and we've got our ladder up, but we're not exactly sure if those rails there are going to be able to hold our weight. When you think about the tailwinds, the things that are going to be in our favor here and would support a quicker recovery rather than a slower recovery, and when Chris was talking about that U-shaped, you know, I think a lot of times when we go into a recession, we think it's going to do like this, right? And some people say now, well, we're going to do like this, and then we'll recover, and then we'll probably fall back again. Jerry's got a little story that relates to that before we actually come out of it. And my personal opinion is that we're down here at the bottom sort of going along, and we could go along down here for a long time. But we do have some tailwinds. Loose monetary policy is one. The Cash for Clunkers program, that it's over now, but if people think that's a good idea, we'll probably see other ones like it as we try to speed our way out of this trough. First-time home buyers tax credit, we know that's going to expire in November, I think, but there's already language to extend that and perhaps even extend it to all people that might be in the market to buy a home rather than just first-time home buyers. And finally, the recovering equity market. If you left your money in the stock market from December to March, you were probably really sorry that you did that. And if you then left it from March till September, you should have been pretty happy that you did that. And I believe that's going to be a tailwind for us. As we look more down into the details here, this is just a chart that captures the various interest rates in our economy. The Treasury rates, the short-term, the 1-year, 10-year, and 30-year Treasury rates. The 30-year Treasury turns out to be a benchmark rate for conventional mortgage rates. So when we say the Fed is operating with a very loose monetary policy, we're keeping the Fed funds rate, which isn't even on my chart, at near zero, and they've said in the past that they expect to maintain it at that level for a period of time. So in an economy where there's very little growth, we know that the Fed can't drop interest rates any lower than what it is in order to speed us out of this period and into a recovery period. But I think that the Fed is doing everything it can to not just hold short-term interest rates down, but even to hold long-term interest rates down. That long-term rate does influence the conventional mortgage rate. And most people believe that we have to get the housing market to recover before we'll have real recovery. So anyway, the Fed is out there being a real big tailwind for us. I spoke of the household net worth. When we went into 2008, you see all of the changes in household wealth in 2008 were negative. In total, we lost about $12 trillion in household wealth during 2008. Now, just to put that in perspective, the whole GDP is about $12 trillion. All the money all of us make in a year is about $12 trillion. So this was a major hit. And this is just households that I'm talking about. It's not universities and other entities out there like that. Well, in the first quarter of 2009, as I said, through March, the stock market lost quite a bit of value. So 2009 didn't start out well. But in the two quarters, the second and the third quarter of 2009, I know for sure that we had an increase in household wealth in 2009 second quarter of about $2 trillion. The red mark there is my estimate of what the minimum change will be in the third quarter, because we know the stock market went up by about that much again in the third quarter of 2009. So to the extent that people's spending is a function of how wealthy they feel as opposed to how much income they're making. This recovery in household wealth is a positive. It is a tailwind for growth in the economy. The sort of interesting thing about this is back here in 2003, 4, 5, 6, and 7, an awful lot of the spending that took place was because people had wealth being created in the housing sector as well as in the stock market. We had a great asset effect going on driving the economy. And what's going on now, or as opposed to this earlier period of time, 67% of us own a home. About 40% of households have stock, own equity in financial assets. So the recovery or the tailwind is not as broad-based now as it was back in the 2003 through 2007 period. In other words, we're going to be experiencing for a long time really no change in aggregate wealth coming from household values going up. So those of us who have money in the stock market feel like things are getting better. If you didn't have that exposure and you just had money in housing and had some wealth being created there, it's a lot harder for you to feel wealthier, so that'll motivate you to spend money. But a little bit of positive is better than no positive at all. The cash for clunkers was a very important tailwind that's going to drive GDP growth in the third quarter. My chart here is that annualized number of light trucks and autos per month that are sold. So I'd really tell two stories with this chart. One is you can see how significant that Cash for Clunkers program was in terms of driving annualized auto sales from around 9 million, which is very low for us during this period of time, up to about 14.5 million. Now we all know that people pulled purchases that they were going to make later. They pulled those into those months when that program was available, or they just slowed down and they delayed till they could take the benefit of that. But anyway, just the spending that took place with regard to this program is going to add several percentage points to GDP growth and consumer spending in the third quarter. Finally, we are getting some housing market recovery. This is the existing home sales that the National Association of Realtors puts out. So you can see going back to 2001, our normal annualized number of existing homes that would trade in a year is around 5 million.